How overpriced does implied volatility get?
And how am I measuring this?
A percentage. 1%, 5%, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65, 70, 75, 80, 85, 90, or 100% overpriced. How overpriced does implied volatility get between 0 and 100?
Wow. In what?
I love doing this to Tony, by the way.
Of course. In what period of time?
Every month.
Every month.
Every cycle.
Every cycle. How much does it get? Oh, that's a great one. I would have to say 8 to 15%. Can I have a range?
Yeah, you could do whatever you want.
8 to 15%.
That's pretty damn good. I'm surprised. All right, let's go to the next
Seriously?
slide. Yeah.
I got to be honest with you, and I know this is sponsored by the CBOE and everything else like that, and I hate to be wrong when it's going to be seen by so many people, but I took a shot.
I know you did, but that's why you're a professional market maker, or were.
Now I'm a professional flunky, and I am a food getter for you. I'm wait staff.
Implied volatility comes down. Implied volatility comes from option pricing models that can be used to compare the expectation of a stock's price moves over the next year. Example, the SPY has implied volatility of 18, and Tesla has implied volatility of 54, meaning that Tesla is expected to be 3 times more volatile than the SPY over the next year. Simple, right?
Sure, just math.
Okay, just math. Next slide. So we can measure the realized volatility as a number that shows what the stock's volatility actually was over a certain period. So implied volatility will usually be higher than what actually happens. And of course, I think it's about 85% of the time, implied volatility, what could happen is going to be higher than what actually happens. And there's lots of reasons for that. But obviously, you're never going to price stuff too cheap. You have to price stuff, by design, it has to be priced a little expensive, because if you sell it, you have limited profitability and unlimited risk. So you've got to have a little bit of edge that way. So let's go to the next slide. If we look at a variety of stocks and separate them by high and low implied volatility, what will the overstatement percentage and spread be for each group? Interesting. If we look at a variety of stocks and separate them by high and low implied volatility, what will the overstatement percentage be for each group? In other words, will the overstatement be higher for high volatility, or would it be higher for low volatility, or will it be the same?
I don't know.
Let's take a look. So here's the study, which is really a good one. We studied 568 underlyings ranging from index ETFs, sector ETFs, commodity ETFs, and individual stocks. We basically took the S&P 500 and then added a bunch of ETFs and indexes to it. We split the group into 2 buckets. Implied volatility into 2 IV buckets: implied volatility less than 25 and implied volatility greater than 25. And then we compared implied volatility, it's not IVR, but there's implied volatility, and HV, which is historical volatility, which actually happened over the last 30 days. And then we recorded the average IV minus HV spread for both groups. So we basically looked at 30-day periods and just compared implied volatility expected to historical realized, and did it based on low volatility underlyings and high volatility underlyings. 568 underlyings, a massive amount of research went into this. Next slide. So for stocks with higher implied volatility, the spread was around 2 times that in points than for stocks with lower implied volatility. So what higher implied volatility means essentially is higher risk reward, right? That's what high implied volatility means.
You would hope. right? A perfect math model, that's the way it's going to be.
And so what happens here, you can see it's implied volatility is almost 2 times the risk reward of low volatility. So when we looked at the average IV and then the historical IV. And the first thing you see in the first column when IV is less than 25 is that the average implied volatility is about just under 21, right? And the average historical volatility, or what actually happened, is just under 19. So that means that the difference between those two was about 10%. Tony, you said 8 to 15. That qualifies.
Yeah, not bad. I think I deserve something. I mean,
no, you're going to get a huge. You're going to get something huge. You're going to get a gift like you can't even believe. It's a good market though. 8.15 is a solid market. 10 was right in between. But then, if you look at the implied volatility of greater than 25, right? The average implied volatility is 36.6. The average realized volatility was 32.2. If you take the difference between those two, it's just over 10%. So in both cases, it's between 10 and 11%. And as you can see there, the average spread's just double. Everything's just double on the higher volatility. So what that means is there's no real difference between low implied volatility and high implied volatility, meaning the spread between expected and realized is virtually the same. But, you take twice as much risk with high volatility, but you get twice the reward.
Darn, they're good. These option pricing.
Darn, they're freaking good, is right.
They are good. They are good.
Let's go to the next slide. So the spread widened proportionally to the level of implied volatility. 2 times the implied volatility resulted in roughly 2 times the spread, and therefore the same ratio of the spread to raw implied volatility. So this suggests that option premium in both high and low IV is priced in with the same efficiency, just like you said. Damn, they're good. Right? And again, this could be just, this could be a tiny little margin of, whatever, but it's close enough, 10, 12%, 10, 11%, whatever it is. Basically meaning there's no more edge if you trade low volatility or high volatility, you just take less risk with low volatility stocks. That's all there is to it. Let's go to the next slide. So the takeaways. Overstatement is efficient regardless of the level of raw IV. So of the 568 underlyings tested. So IV overstated actual volatility roughly by 10% in both low and high groups. And the higher IV underlyings saw a higher overstatement in raw points, meaning that higher IV means proportionately, and that's the key, proportionally higher risk and higher rewards.
It's a really nice way of summing up higher implied volatility. People always think, maybe it doesn't come with this with proportional risk, but it does, and that's really the key to this whole piece, which was very nice. Good job by them. Good job by the team. We'll take a quick 90-second break. We'll come back. Oh joy, Mr. Scott Sheridan next is Tasty Live.